Hey, good evening, good day, everyone, and welcome to our training today. Today's session, we're going to be looking at the very interesting concepts when it comes to technical analysis. However, it is you look to analyze the markets, be it smart money type concepts or just basic technical analysis. Understanding market structure is very useful. Is actually quite useful, and applying that to Fibonacci as well could help you if you're trying to figure out a strategy or something that could potentially work for you. Okay, so as usual, my name is Nana Obina Alexander. I'm the head market analyst here at Anzu Capital, and I'm also the senior educator. So stay tuned for almost all these trainings. You have me on board. Okay, so here's what we'll be discussing today. Basically, the main content of this, and then we'll go over and even look at some examples. We'll look at market structure, right? So what exactly is market structure, at least my own perspective of it. And then we'll also look at Fibonacci, what Fibonacci is and also my application of it. And then we'll see how we can merge both of them together to somewhat have a way to view the markets, right? Now, let's jump straight into the first point, which is market structure. Now, market structure, right? This basically acts as a guide for us to understand the upwards, downward, or sideways nature of a trend, right? Now, this principle can be applied to any type of market, whether you're talking about stocks, future, forex, commodities, even cryptocurrencies. Now, it's basically anything that anything that has price and that moves over time can be plotted into a chart. And once it's plotted into a chart, you can see the trend. So this is what you call trend. You could see the structure of the market as to whether it's moving upward, what we call an uptrend, or moving downward, what we refer to as a downtrend or a bearish market, or going side to side or a ranging market. Now, the idea of looking at structure of the market is actually quite critical because understanding the phase of the market that you are is very, very important to giving you a shot at being profitable or finding good trades. So it's actually quite important. Now, it is the framework or the structure that any given market is currently trading in. So if you look at the market, you see that you can be able to see, at least based on the time frame you're looking at, if the market is bullish or trending higher, bearish or trending lower, or ranging side to side. Understanding this can help you understand the behavior conditions, the current flow of the market. This helps you analyze the potential support and resistance or supply and demand zone, the swing highs and the swing low in the market. And this is very good, very important for your trading arsenal. Now, what are the type of market structures, right? So when we talk about market structures, we've talked about them, but let's just quickly look at them a bit. So there are three different distinct categories. The first one is the bullish market, or what you call an uptrend. Now, in a bullish market, the structure of a bullish market is defined by a series of higher highs and higher lows. Now, so basically, the trend continues in the same direction until a reversal is done. So it probably looks something like this. Now, you know a market is bullish when you see that it's clearly making higher high and the higher low. So a bullish market is one of interest. So if you're, if the market is making highs and then making lows and then making highs again and lows, this is what you refer to as a bullish market, so or you call an uptrend. Basically, the market is heading upwards. Now, the other type of structure is the bearish market. And in a bearish market, the structure is defined by a series of lower lows and lower highs. And in this type of markets, price tends to continue in the direction, making new lows, right? So what you notice is in a bullish market, price trends higher, and there's a likelihood that price will take out previous high than break lower. In the bearish market, price is trending lower, making lower lows and lower highs. So in the bearish market, each new low is a potential target for the next lower high. So if the price makes a new lower high, so for example, what I mean is in a bearish market, the price makes a low and then makes a high, which is lower than the previous high. As you can see, this low here, this high here is lower than the previous high. And then the market comes on to make a new low, right? Which is also lower than the previous low. So in a bearish market, therefore, if price has made a high, we can potentially start targeting this low because, well, price is expected to come back and make a new low. So in the bearish markets, price targets the low, and in the bullish markets, price targets the highs because price starts to make higher lows and higher highs. Okay. Now, so example, this is basically what it looks like. Now, obviously, our illustrations just show a perfect higher lows and higher highs, but you get the whole idea. Now, the next form of market is the sideways market. Now, the sideways market structure, in the sideways market structure, price tend to move from side to side, right? So price tends to go from left to right, but not really making highs or lows. So it's making what we call equal highs or equal lows. Now, you might not expect to see an exact equal highs or equal lows in price, but basically the idea is in a bearish market, right? In a sideways market, price would make relatively equal highs and equal lows. Some might be not as high as the others, but you could see in a nutshell, price is moving side to side, not really gaining ground or losing it either. Okay. So now, market structure, why is it important? It's actually important whether you're a new trader or you're a professional trader. It doesn't really matter how long you've been trading the market. Understanding structure in the market is very, very important because it can help us understand where the liquidity is and also help us to figure out what price action to pay attention to in the market. It is also one of the most commonly used techniques to understand trends, identify potential reversal points, and also get a feel for the market's conditions. So if the market is bullish, you can start to look for bullish conformations, bullish movement in the direction of price because you understand the structure of the market. And then you also understand that market tends to move in that structure. Now, just as a side point, just as a nugget, market structure is relative. So basically, the forex market is fractal in the sense that from a lower time frame to higher time frame, you will still see the same type of market structure: lower lows, lower highs. In a bearish market, higher lows, higher highs. In a bullish market, but you need to understand that the higher time frame takes priority. The higher time frame controls the lower time frame. So a structure on the higher time frame has more precedence than that on the lower time frame. Now, because the market structure is a reflection of the two-way auction process, that is the psychological change in market sentiments, it provides an incredible insight into how the market is behaving. And it actually sums up the entirety of the market and gives us clue as to where price action is headed next. Don't worry, when we start to, I'll show you examples of this in the market, especially when we start to apply this to the Fibonacci, okay? Now, market structure is also helpful to create efficient markets. It helps us to create efficient markets in terms of the asset price reflection because everything, the whole, whether be it the news, the FOMC, the non-farm payroll, every of those information is reflected on price. So by looking at price, it is a sum total of all the influence, both macroeconomics, fundamentals, technicals, sentimentals. It takes everything into consideration, and you can see it by looking at the market as to whether this market is bullish overall, bearish overall, or really in a range. Okay. Now, how do you use market structure? Right? How do you use market structure? A market structure can help you to define if-then scenarios. For example, if a structure breaks, right? So if the market has been going upward, that means making higher highs and higher lows, and then all of a sudden it breaks, right? You can then start to look to move in the opposite direction. So this can help you understand, help you to spot potential change in trend. Now, there's a deeper fundamental, a deeper understanding to this, which I'll probably cover in some later videos. And this is where we start to look at Elliott wave theorem and then how we merge that into Dow's theorem, right? So even though sometimes the structure might break, but the market is still overall within a particular direction. And this is also where the fractal nature of the market is where sometimes a break of structure in a lower time frame is not enough to change the trend because the higher time frame structure is what is in place. Okay, so basically we can use market structure to define if then scenarios like where the market is about to change trend. So as you can see here, price is making higher highs, higher lows, higher highs, higher lows, higher highs. Then all of a sudden price made a lower low. We can expect a potential lower high to then make a new lower low. So this can help us to get into or prepare ourselves to get into potential trades based on understanding the structure of the markets. Now, everybody knows this statement, the trend, at least if you don't know, you should know now. It's the popular saying that the trend is your friend until it's broken, right? So the market, basically, this is one of the most popular expressions in the trading world. And it's a fact because the market structure identifies the trend. Now, more often than not, price would continue in the same direction. So think about it. If you're running forward, it's easier for you to keep running forward than for you to change and start running backward. Why? Because of something called momentum, right? Now, due to this simple fact of momentum, the fact that if the market is in a particular direction, if buyers are in control and the market is trending bullish, right, there's a higher probability that price would continue to trend further bullish. Because in order for price to trend, to change direction and start going bearish, it requires a significant amount of effort. In this case, a significant amount of volume. Because what it means, a bullish market means there are already buyers. A lot of people are already in the market. A lot of people are already buying the markets, right? For these markets to reverse, so when I say reverse, I don't mean small retracements. I mean reverse. It means that all those buyers, they either stop buying, give up their buys, or huge sellers, aggressive sellers come in that overshadows the buy. And obviously, it's not always that straightforward. Yes, the market reverses, but it trends most of the time. Now, in the forex market, for the price to reverse, a significant volume is required. Somewhat like reversing the direction of a speeding car, right? A car is moving forward, right? You can steer to the right, you could steer to the left, you could maneuver and do all of those things. But imagine trying to immediately reverse a car that is already going forward. The engine would have to stop and then start again, but in the opposite direction. So it takes more power. It requires more inertia for that to happen. So understanding the concept of trend and that the price tends to stay in a particular trend longer than most people think it will is key. And then having a system or developing a system for yourself where you can look to trade in the direction of the trend is very, very, very important if you're going to, find joy in these markets. Now, we've talked about market structure for a while. We've explained certain concepts. We understand the three major market movement or price or market trends, which is the bullish, bearish, and sideways. Now, we're going to also look a little bit at Fibonacci before we go and look at some examples. So what exactly is Fibonacci? Where did the concept come from? How do we apply it to market structure? Probably why is it important, right? Now, Fibonacci was, Fibonacci that you all see in the forex market was actually gotten from a famous Italian mathematician named Leonardo Fibonacci. Now, he discovered a simple series of numbers that created ratios describing the natural proportions of things in the universe. Now, the beautiful thing about Fibonacci, or the Fibonacci sequence, is that it can explain almost everything. Like it's applied in almost everything in the universe. Look at the palm of your hand. The sequence, the way your fingerprints are aligned, you look at the shape of, the shape of the moon, the shape of the universe or the solar system in our universe, the shape of the Milky Way galaxy in the solar system and in the universe. It all reflects the Fibonacci sequence. It's reflected in leaves, it's reflected in your eyes. Well, this guy has to be very intelligent or very lucky to stumble on this. Also, basically, the ratio arises from the series of a following number. So it starts by having the number 0, which is the first number on the numeric table, basically, followed by 1. So you have 0, and then you have 1. So basically, it looks something like this. So you have 1, so obviously 0, and then you have 1, then you have 1, 1. And so what you do, you have 1 again, and then you add 1 plus 1. So you have 2, and then you have 1. So basically what it is a series of numbers starting from 0, followed by 1, and then you add 0, you add 1 to the 0, and then you add the second number to the third number, and you end up having something like this, where it's 1, 1, 2, 3, 5, 8, 13, 24, 21, 34, 55. But that's the sequence, right? So this is the Fibonacci sequence. Some of you might have done this in school, in mathematics class. I think it's something like I did it in 500 or 400 level, something like that. Right now, the numbers themselves, or the sequence in themselves, is fascinating on their own, but it's the ratios that begins to get interesting, right? After the first few numbers in the sequence, if you measure the ratio of any of the number, right, succeeding a higher number, you get 0.618, right? So for example, if you have 34, so let's say it's 34 divided by 55, it will give you 618. You take 55 divided by 89, still give you 618. You take 89 divided by 144, it will still give you 618. Continue like that to the infinity, it will always give you 618. That's 0.618. Now, if you measure the ratio between the alternate numbers, so you say 21 divided by 55, or 55 divided by 144, or 34 divided by 89, it will give you 0.38, right? So this sequence continues on and on and on there and on. And so what happens is there are several applications of the Fibonacci sequence in maths, in science, in every other place. And then somebody decided to put it together and put it into the forex market. See, does this work as well? Would this apply to the forex market? And lo and behold, it became evident that the market somewhat respects the sequence, the Fibonacci. At least in some instance, the market tends to follow the Fibonacci pattern. Now, just like everything else, when applied incorrectly, will give you incorrect results. And we'll see how we can apply the Fibonacci itself, or the Fibonacci sequence, to the forex market using market structure. So these are the popular Fibonacci retracement level: 0.236, 0.382, 0.618, and 0.786 or 764. Now, many of you already know the Fibonacci tool. I'm sure all of you probably already know the Fibonacci tool. But it's just a brief understanding of background of the Fibonacci and why it's used. Now, there's also the Fibonacci expansion levels and all of that, but I'm not going to be talking about those because I don't really use them. I'm not, it doesn't really apply to what we are trying to do. The Fibonacci expansion level is gotten from the Fibonacci expansion ratios, which is now the 1.168, which gives you a potential profit-taking target. Okay, so now we have done all of that. We've explained the market structure. We've also explained we've also explained Fibonacci. We understand market structure, the different structures in the market. We also looked at Fibonacci, the sequence, the ratios, how we can, we'll now see how we can potentially merge these two together and come up with an idea. But before we go over to the chart, let's go over to our drawing board once more. And, basically, just draw a rough sketch of what we're trying to do. So basically, we understand something from market structure. What is that? Well, the market is usually trending. So sometimes it's bullish, making higher highs and higher lows. And then sometimes it might range a little bit. And then other times it might be bearish. And then it might be bullish again. So we know that the market goes from maybe, range between bullish, maybe a little bit sideways, bearish, then bullish. Now, it doesn't mean it goes from bullish, bearish, sideways. No, it can do any one at any point in any order, right? But the idea is the market is going from one mode to another mode, right? So we know one thing for sure. In a particular mode, in a particular trend, if the market is going bullish, we try to look for buying opportunity. We are going to find it more joyful to look for buying opportunity because the market is most likely going to trend in that same direction. And in the bearish market, market's most likely going to trade in the bearish direction. Yeah, and in a bullish market, it's most likely trade in the bullish direction. We stay away from the sideways market because, well, the market is just indecisive. There's a different concept of how to look at that, probably for a different training video entirely. But we understand the concept that price moves in different phases, or what you call trends, which evidently is the consequences of market structure. Now, we've now looked at Fibonacci and saying, okay, this sequence, there are certain ratios that are universally accepted, universally respected by nature itself, and also respected in the markets. And we saw those sequences as 0.236, we had 0.382, 0.618, and we also had the 0.786 or sometimes 764 as well. So now we're going to the basic idea is this. Once we figure out the trend, and how do we know the trend? Well, we know the trend of a market by looking at the delivering of price. So if price is delivering bullish, making higher highs, higher lows, higher highs, right? So this is higher high, right? So this is a higher high, and this is also a higher high, and this is a low, and this is a higher low. So this market is looking bullish. So in a bullish market, we expect that price would continue to do what? Go up and take out the highs, right? So we've seen the market, we've understood the structure, and then we understand what to look for. So if we come to our chart and we see a market looking bullish, and how do we know it's bullish? By seeing the structure. Well, we can now apply our Fib or our Fibonacci to it. How do we do that? Pull up your Fibonacci retracements to you go from, so in a bullish market, you draw from low to high, and it will plot out the Fibonacci levels. So the 618, the 386, and the 786. You might need to add the 786, but it will draw the 0.236, the 618, the 382. It will also add the 50 retracement level. Now, the 50 retracement level is not technically a Fibonacci sequence number. It's just the halfway point. So the 50 level of the Fibonacci is not a Fibonacci sequence itself, but what we realize is sometimes the market tends to respect it. So once we've understood the structure, we've drawn our levels. So basically, we are looking for these levels as potential areas where the market would continue the reversal, the continuation. So remember that we've said in a bullish market, there is a good chance price would continue to go up. However, we don't know where that will happen. We're not God. We don't see the future. If I could see the future, even if I could see 10 minutes into the future, I'll probably be the richest man in the world. However, we can't see the future, right? And so, but we can use our knowledge of the past, what we know of the past, to try and make future analysis and make analysis or expectation of what could happen. So knowing that the market is most likely going to go up, we now start to look for opportunities or potential areas where the market could begin to reverse or to begin to continue in the direction of the trend. So the Fibonacci 618, 382, even the 236 are key levels where the markets could potentially maybe reverse from here and continue going up, right? Reverse from here and continue going up, or give you a deeper retracement and then continue going up, right? So it's going to be the same mode of operandum if you're looking at the bearish markets. In the bearish markets, we have lower lows, lower highs, lower lows, lower highs, lower lows. So in the bearish market, we're anticipating that price is going to do what? Want to continue going down. So we plot our Fibonacci in this case from high to low, and it will draw a Fibonacci sequence, the 236, the 382, the 50, and the 61.8 Fibonacci retracement level. And if you like, you can add 78.6. And what we are looking for is potential reversals from any of those areas. Now, what you notice is this. Forex trading is in order to become a successful trader, you need to bring in a number of factors and then build a system for yourself around it, right? I could have thought market structure differently and Fibonacci different, but I'm putting them together as an application, but that doesn't mean that has to be all. Well, you can also use other means of confirmation. So for example, you have what this Fibonacci does for you is not it doesn't tell you where to trade or where not to trade, but it gives you potential areas of where price could most likely be headed towards, right? So what you can then do is look for more confirmation. So think about it like this, right? Somebody tells you, okay, so Obina, you see when you see the cloud, Like when you look outside and you see in the daytime and it's getting dark, right? Just know that it potentially wants to rain. Like, oh, okay, that's a good information. But is it every time it gets dark that it rains? Well, no, right? But it usually tends to get dark before it rains. So it will get dark when it's raining, but not every time it gets dark will it rain. Now, somebody might also say, well, anytime you look at the birds and you see them, they are running away, or you look at them as they're migrating, then it's definitely going to rain. Well, it's not every time the birds move away or animals move away that it's going to rain. However, when the cloud is dark and the birds are running away and the ants are running away, then it's, it's now, so we're now adding more confluence. Okay, this criteria plus that criteria, and all of a sudden, you have a higher probability. Even at that, it might still not rain, right? You're never going to be able to get all your trade right. But there's a higher chance that you'll be right because, well, you have confluence in your facts that are confirming the same evidence, right? So first of all, we're looking at the direction of the market. The market structure tells us what direction to look for, right? The problem is most people is they see price start making, maybe they see price start going up. And then they're like, oh, the market is now ready to go higher. Let us start buying. And all of a sudden, the market comes down and they're wondering, what is the problem? Right? Why is this happening to me? Other times, maybe they learn your thoughts, price action, candlestick formations, bullish patterns, shooting stars, inverted hammer, all of those things, right? Which in themselves are quite useful. But then somebody sees a bullish hammer, a bullish candlestick here, right? And starts to buy. So let's say somebody sees a bullish candlestick here and says, oh, this market is ready to start going up. And then the person starts to buy, and all of a sudden the market fails, right? It's not the candlestick that is the problem. It's not the setup that is the problem. It's the application of it. However, once you've understood market structure, like, okay, most likely, right? Most likely. The reason I say most likely is because if the market structure is always guaranteed, then there will be no trend. It will only be one trend. That means every single market will be trending one direction. But we know that trend breaks and trend change, right? Which market structure will also help us to identify. But knowing those two things, we can now start to look for bearish confirmation. Why are we looking for bearish confirmation in this case? Because we understood that the market is bearish, most likely going to stay bearish. And we have just broken previous area, like we could see that we've broken down again. So any movement upwards could just be potential retracement before price continues downward, right? Now, what would be the point of negation for a particular bias? So in this particular instance here, being a bearish bias, if price were to break up and take out this high here, then it means there's a good chance price is no longer interested in going down and maybe price wants to start going up, right? So it means, so that is going to be our point of negation. That means if price gets to that point and takes it out, then we should probably, market is no longer interested in probably going down and maybe you want to start going up. Okay, so as price approach any of those fib levels, we can start to look for confirmation. Some other people can just place pending orders. It's dependent on, there's no right or wrong way. You just need to figure out what way you want to trade and stick to it using proper risk management and trade psychology as well. And then you can get into trades. Remember, so if you're going to, it depends on how you're getting involved in it. I'm not going to talk about the exact way you can trade this or not. But basically, if you're aggressive, your stop losses should just be at this highs. So Fibonacci sequence is plotted like this. This is an A, right? B, the market tends to move in A, B, C, D type of pattern, and then retrace into a C to then go and give you a D, right? So then go and give you a D. So the market is constantly moving in an A, B, C, D pattern and over and over and over again. So once we allow the market to show us the A, B, retrace into a C, and then we look to trade from C to D. So basically, this, even though the example I showed is for bearish market, you can flip it over and it will apply for a bullish market. So let's jump over, go to the chart and see, see some examples of how we could potentially look to trade this. So quickly, let me just share my chat screen. Let me just quickly share. Okay, so now we have a chart. We're just using the chart of Euro USD, and now this will work on every single currency pair, every single asset class, like we mentioned, and even on every single time frame, right? So you can apply this to whatever, depending on the type of trader you are, you can find a way to apply this to suit your system. Now, talking about market structure, you can see here that the market is always moving in some sort of structure, right? Look at this. At some point, the market was bearish. Okay, so where's my two? Okay. At some point, the market was bearish, right? And then shifted bullish into being bearish again, right? And again, shifting bullish, ranging a little bit, breaking down bearish, and then ranging for a longer time. You can see this is a ranging market, and then shifting again bullish, breaking down bearish. It could all be confusing, but understanding where you are in price or in the market is quite essential. And then the market broke up bullish here, so then stay bullish for a while, and then broke down bearish here and stayed bearish, and is still bearish. So most likely the potential movement for Euro USD is for it to continue to go down. We don't, I know everybody likes to look for reversal, but looking at this, the market has been bearish, and what is it most likely going to want to do? Will continue to go bearish. Now, obviously, it's not going to stay like that forever. At some point, it will probably start breaking bullish, and then maybe continuing bearish and all. So obviously, we get the idea of market structure. Now, how do we apply that to this? How do we apply that to a trading system and also use Fibonacci as well? Now, think about this. At this point here, the market broke bullish. So let me just show this. At this point here, the market broke bullish by taking out previous highs. And what the price begin to do? Well, price begin to break even bullish. So anytime, so this, let me just copy this and paste it here. So notice the price will do this. It broke bullish, pulled back, broke bullish again, came back, tried to go up, but failed to go up, and then broke bearish. So at this point here, price broke down. And since breaking down here, what has price continued to do? Well, stay bearish. Now, here's the thing, right? Here's the thing. Like we mentioned, a market likes to stay in a particular direction even longer than most people think it will, right? It stays in that direction longer than most people anticipate it will. Notice how from breaking down bearish here, the market continued to break even bearish. Like it continued to break bearish further. It broke down again here, broke down again here, here, broke down here again, and has just been breaking lower. So it means the price is targeting the lows. That's where the liquidity is, and that's what the market is going after. Now, it's not going to stay like that forever, but as far as we're concerned, that's what the market is going after now. So in this market, what are we looking for? We're looking for bearishness. We're looking for sales. Now, it's not just in this market, in this time frame. Right? Now, in the intermediate, let's say you're trading in the 15-minute chart or thereabouts, you would be able to find bullishness. There are certain times the market will appear to still be bullish within the same structure. And within that smaller time frame, you'll be able to trade it also based on the using the same concepts that we're looking at here, right? But just looking at this particular time frame, so let's see what we would have done. So the market broke down bearish here, following the overall structure. Now let me use the replay tool. Let's take this for instance, and so from the market got to this point, broke down bearish, right? So this is what price would have looked at. We saw the break of structure here, break again here, break down here. And this is this was the high. Where's my circle too? So this was the high, right? That caused this low, right? And so what do we look for? Well, we'll pull out our Fibonacci retracement. So now the Fib 2, you can get that in the whether you're on the MT4 or your mobile phone or your laptop or desktop, you can get the MT4 on it. You can get the Fibonacci retracement. So there, it's somewhere at the top. You should watch some of my previous videos on the MT4 application itself if you don't know how to use it. Now you go from high, because we're bearish, because the market is bearish, we go from high to low, right? So we draw our Fibonacci from high to low, right? Now, what do we do? What do we do then? Well, we look for continuation for price to come down and take out this low, right? So as price is coming down, we broke down here, we draw our Fibonacci. The moment price start making, the moment price begins to make, like, pull back and make a move higher in the overall direction of the trend, against the direction of the trend, we then pull our Fib to draw and figure out our Fib level. So you can see, I don't know if you can see this clearly, but you can see we have our 38.2, our 50.0, our 61.8. I removed the 23.6 because I don't really use it because it's too close, right? So sometimes the market doesn't make deep retracements, it just retrace only slightly. In that case, well, I don't like to trade the 20. I don't want to pay attention to the 23.6. Now, I don't necessarily trade just Fib or anything like that, but it's actually quite vital to understand, especially for some of you new traders. Now, see where the markets pull back up to. So let me just use this to, so you see the market, see where it retraced from. It pulled out, came up to the 50.0, even deeper, slightly almost to the 61.8, and began to retrace, right? So let's say for the sake of this particular class, we are looking to trade only the 61.8. So anything between the 50.0 and the 61.8, right? Now you have to define trading. You have to define how you trade. You cannot just trade anything you see. You have to define criteria that has to be met for you to get into a position, right? It's very important. So you might say, okay, I look to trade, continue in the direction of the market. I look to trade the Fib levels, maybe the 618, between the 618, between the 50 retracement level to the 78.6 retracement level. So anywhere between this zone, so let me just draw this out. Let's say anywhere between the 50 to, let's say, the just to the, basically without taking out the high, this is potential area to look for opportunity to sell, or maybe just place a pending order and start selling and keep your stop loss above here. But then you also need to have rules as to, okay, the risk to reward ratio, it has to be at least 1:this or 1:that, or you can even say you wouldn't risk S amount, right? So in this case, let's say we are only trading the 61.8. So let's just say for this example, we're going to look to trade just the 618 to this highs. So what happens is, in this case, we don't take any trade because the market did not retrace to our level. Well, what happens? We continue to move. The price continued to move. Notice, so I went too fast. So price continued to move, right? Let me just reduce this a bit. So now let's say price continues to move, and now we broke down. Now, the moment the price breaks below this low, right? The moment price breaks below this low, this particular setup is now invalid. So remember, I said the price moves from A, B, C, D type of setup. So A, we'll call this will be, okay, let me make that bigger. Let's make this bigger. So price goes from A, right? Okay, to B. So price goes from A to B. So this will be B. So we're expecting price to come back to a C, right? So we'll call this C. For it to then go on to hit our target at D. So the A, B, C, D type setup, right? So in this case, price came back, but it did not get to, let's say, where we're looking at, right? We didn't get in on this trade. But the moment price breaks below B in a bearish market, in a bullish market, if it breaks above B, that particular setup is now invalid, right? So the moment this happens, you don't keep looking for sells. You don't keep looking for sell opportunity if price start coming back up. So somebody, let's say the price now start coming back up here. You don't now still keep looking for sell, because this setup has been completed, right? This setup has been completed. So if price breaks like this, it's probably creating a new different setup, maybe bullish, right? So you have to be aware of that. So what that means is we now have a new setup. This is our new A, and our D becomes our new B. And what are we looking for? We are waiting for price to make a new C for it to give us an entry for a new D. Now, at this point, you ask, where do I draw my Fibonacci from? Well, what you want to see is this. You want to see the price make, so let me go back to our, where is my, okay. Since I closed it. So you want to see price, okay. Yeah, you want to see, what you want to see, let's say the market is breaking down, going down, and you have your A, you're probably waiting for where to draw where your B will start from. What you want to see is you want to see the market at least make 2 candles. So this candle needs to be greater, needs to be lower than 2 candles to the left and 2 candles to the right? So what that means is, let's say we have, all of these are candlesticks, right? Bearish, bearish, bearish. And then we have a candle that is then, so let me make this green, right? Something like this. So you can see that the low of this candle is lower than at least 2 candles to the left and at least 2 candles to the right. Then you can now make this your A and make this your B and just draw your fib. Remember, you're just drawing your fib at this point. So you draw your fib, you get your fib levels. Now, sometimes the market would make you do something like this, where it gives you 2 candles to the left and 2 candles to the right, and then continues to go down. No problem. This you now you still keep looking for a new, what do you call it, B, as long as this doesn't go in deep, right? So sometimes, here's what I mean. Let me go back to the chart. So for instance, well, there was none here, right? Notice how each time, each low, there's no 2 candles to the left, 2 candles to the right? Let me see if I can find one. Even this one, right? But look at this, right? So price went from here. See this low here. I don't know if you can see it. We have this low here. It is lower than 2 candles to the left and also 2 candles to the right. But then price broke down, right? So this is, if you zoom out, you see this is still the direct. It's still one straight move, right? But notice what happens at this point. The market begins to push up. So we have this. So at this point here, this is what we'll do. We'll pull out our fib 2. We go from our A to our B, and we are just waiting, right? We're just waiting for price to come into the area we are interested in. Now, remember we said we're looking to trade, we're going to look for opportunities within the 618 to the 0. So this is where 618 is. 618 is here to this area here without taking out the high. That's an area we're interested in getting in. So you can place pending orders. You can look for confirmation within here, maybe trend line break, candlestick formations, any of those fancy stuffs. And then we wait, right? Success in trading involves a lot of patience. I know a lot of people who want to trade every day. They want to trade every single thing because they think that's how you make money. No, you don't make profits in the market by trading often. Trading often doesn't mean trading well, right? The goal should not be to trade often, but to trade well. Now this is a daily chart, so probably will take a couple of days. And the price, let's see if it gets there. Now, at this point, price has gotten into an area we are interested in. Now, if you place the pending order, now for the sake of simplicity, I'm not going to go down into breaking any system or anything. Let's just say we place pending order, right, at 618. Let's say now you can say, you can scale into positions where you can say, if I want to take 0.1, if my risk, if the lot size I want to use is 0.1, I will probably break that into 2 points and take 0.05 here. Stop loss, well, what would our stop loss be? Just slightly above the highs. Where would our targets be? Well, our target would be this low. So we can take maybe 0.03 here or 0.04 here, and then take the remaining 0.7 at this other area here, right? Now, it's up to you. I'm not telling you exactly what you should do. This is not exactly how I trade, But you get the idea, right? Now, why are we taking this? Well, because of the anticipation that price is going to want to continue in the direction of the trend. So at this point, this would have triggered our trade, and this one too would have also triggered our trade. So we are waiting, and price is approaching our stop loss. And then what happens? Let's see. Market begins to break down, right? So it goes back up, still doesn't take us out, and begins to break down. Our target is still this low based on the overall structure, right? And we'll try and, obviously, you can take profit and take partials, but probably stay in this trade. And even within this bias, so at this point, we have our full TP. Price has given us our full TP, right? So we are done with that trade. What are we waiting for now? We are waiting for price to make a new low. That means to establish where the new B would be, because this here will now become our new A, right? And we're looking for our new B. And how do we find that out? Well, we want to see the market make a low that is lower than 2 lows to the right and 2 lows to the left. So let's wait. So we keep watching, price keep moving. And then at this point, you can see this low here. At this point, this low here is lower than 2 candles to the left and also 2 candles to the right. So we draw our Fibonacci. So I'm going to delete this so that it doesn't keep looking too much. We pull up our Fib 2 again. Let me just use a different Fib. We draw a Fib from high to this low, wanting price to come to 618 to 786, right? So we can maybe place a pending order here. You can obviously look to scaling, stop loss just above there, and maybe go for this target, right? And then while waiting, now you can also watch for confirmation within this zone to avoid fake out, whichever one you're good with. Now, many times price will probably not come back and give you an entry. But sometimes it will. You have to be okay. Don't try and chase. If you have rules, stick to the rules, come what may, right? So this is A and this is B. Let me pause this. So draw this. So this is our A and this is our, oh, why am I picking the wrong two? And this is, no, Jerry. So let me take you back. So A, this is our B down here. So let me move what's this side. And where's our C? This is our C. So where this red zone is. And we're looking for price to give us a D, right? Why is this so hard? So you get the drill, Jerry. Let's not waste time. And we're looking for price to give us a D, right? But in this case, let's see if it gives us an entry. I don't think it does. Let's see. The moment it breaks below this place, it's no longer valid. And now it has broken below, right? So what happens is, in this particular instance, you see that even though we were correct about the direction of price, we did not get into trades because, well, we did not get filled in. So what we do, that order is out of the way. Note what we then have. We're now looking for a new Fibonacci setup, A to B again, right? So we want to see the price make lows, a new low that is lower than 2 candles to the left, 2 candles to the right. So once we find that, so at this point, we can draw our Fibonacci. So you can see this low is lower. Even if it breaks down, I'll probably wait for another low, right? So let's see. Price continues to, let's see what it does next. Range a little bit here and breaks down, right? Now, in times like this, you could see that there is, even though not as clear, but there is an intermediary structure. It's still bearish, so this will be the over, it's still low to high, right? And all of that. So we keep waiting for a valid setup. So allow this gives us a setup. And we wait and we wait. Now, at this point, actually, right? At this point, we have our A to B. This would be our A here. And this would be our B here. And we are waiting for a potential C, which will identify once we draw our Fib levels. Something like this. And then we'll be waiting for price to come down to a D. So remember, based on what we say, for this test purpose, we're going to use 618 to 786. You can see that it doesn't get there sometimes. if you want to use 50.038.2, it's also fine, but you notice your stop loss will be very far away from your entry, and that might be risky, except you want to maybe put your stop loss above one of the fib levels. So we wait and see if maybe price gives us a setup. And let me play price. So let's see, do we get an entry? Do we get an entry? Nope. Is it going? Let's wait a little. Let me make it faster. Let's make this a little bit faster. Okay, so price doesn't give us an entry. Okay, it hasn't broken down just yet. We're still within that range. And now it has broken down. So price did not give us an entry. We're done with that one, right? No trade there. We move on to the next. We have our new A, right? Our new B. This can actually be your new A, right? And your new B, and then you can still look for setups to get you C and D, whichever ones are valid. So we can go from the overall A here to this new low here. Okay, I don't know if that's going to be the new low nonetheless. So let's wait and see if it breaks down further. Let me see. Okay, so that's the low, right? So that's the low there. So we go from A to B. We draw our fib like so. Let's use this A to B here because this is an established A to B. And then we wait. So if did we get up to the 618? Probably not. Now, if you're using this on a 1 hour chart or a 4 hour chart, you probably get, this is daily chart, so a long time wait. So in this case, you can see that I think we get up to the 618, right? So if I would just pick this, drop it at the 618, yeah. The market came to the 618 in this instance and ran away from there. So maybe our first pending order would have been triggered and we had a trade, stop loss above here, maybe take profit down here, maybe a second trade with a smaller lot here, a slightly bigger lot here, in case it pulls back up, and we just keep going. And then we have full TP, we do the same process over again. Now, I'm not going to go through every single structure here, but you see the idea. The market is moving from A to B, retrace to a C, pull back and takes out D. It does the same thing. A to B, retrace to a C, and pulled out D. So this is how, like, all of the trades, at least on this daily time frame, the same structural application. It's understanding structure that enables us to figure out the trend, and then we try to stay in the direction of the trend by getting involved using the fib retracement levels and using the lows or the highs of the market structure as targets for where our take profit should be. So this is, I know this is based on the, let me delete all of this. It's based on we're using the daily charts, but it doesn't matter even if it's the 1 hour chart, right? You'd see so just simply looking at this, well, what do I see? Market structure, price breaking down. So let me just take this immediate one here. You see price making this highs, higher high, higher low, higher high, makes it higher low, makes it higher high, makes it higher low, makes it higher high. And then what happened? Breaks down lower, right? So now it has broken down lower and is now making lower lows, lower highs, lower lows, lower highs, right? So it's now making this sort of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Now this kind of liquidates that, but it's still lower low, lower high, lower low, lower high, right? Now there's an entire understanding multi-time frame analysis will also help you figure out certain other things that would also improve your system. But just simply looking at this, right? Understanding that price broke higher here, we could have drawn a fib from this point to this point, maybe looking to trade the 618. Price did not get there, so no trade. Again, as price broke out here, we can draw a fib from this point to this point. So notice in this case, right? Price did not give us entry 2 times in a row. No trade. Again, price came here, we go from low to high, and then we got a trade, 618, and price went to give us target. Now, in this case, we probably would have taken a loss, right? So let me just take out this too, right? So in this instance here, the moment we've taken that profit, maybe we go from low to high, looking for price to give us an entry. We don't get an entry, we probably take a loss. Well, we move on. Now, price has broken down. We start looking for structural shift in the opposite direction, high to low. Price did not give us a pullback. Now we have a new high to low. Price gave us a pullback. We got an entry. We took profit here. Again, so let me delete this so that I don't cloud our screen. We now have a new high to low. Price pulled back. You can see that it pulled back into the 618 and then gave us a trade. And then we look. So this is the 1 hour chart. The same thing whether I'm looking on the 4 hour chart. Now, it's not the holy grail of trading, but this is one system that at least you can start looking at and figuring out if it's something you're comfortable with trading and building your own system around it. Now, you don't take anything as face value. You learn a new system, a new strategy in anything, you back test it. You figure out how it would have worked so you can, looking at maybe a particular instrument you might say, okay, I'll trade the 618. Others, you might say, I'll trade the 786. Others, you might be like, I'll trade the 50. But making sure that you test and back test what you have learned before and be convinced about it. Don't just take somebody's words at face value. And then you can now figure out how to apply it to yourself for your own strategy in a way that is peculiar to you, right? So I think this has been a very lengthy training video. Nonetheless, I hope everybody enjoys it, and we're able to break down a number of factors. We looked at market structure, we looked at Fibonacci. So this is kind of like a two-in-one training where we looked at market structure, explained Fibonacci, and it's been interesting for me. I hope it has as well for you. So this will come to the end of our session for today, and then until the next time, I'll see you where we'll have a very good interaction as well.